Will sell in May work in 2024? Welcome to the Foundation for the Study of Cycles, your host, Ron William, FSC Development Director, for our new monthly blog. Top of mind in this month of May, the sell in May pattern, otherwise known as SIM, and the big question whether it will work in 2024, we'll be looking at the pattern, the question of expect the unexpected, so more to follow soon. In addition to the US presidential election, which I was planning on sharing insights on later on in the year, but given that there's this big polarization in the market right now as to how this will impact the SIM seasonality pattern, it just makes sense to cover it now and then maybe follow up closer to the time into the US November period. And to end, last but not least, insights on the markets, simple chart of the S&P 500 and the elevation that we've seen in the last month or so, what it could mean here and now in terms of bullish and bearish scenarios, and most importantly, the timing overlay looking at the FSC model. The SIM pattern, expect the unexpected. Let's take a step back and look at seasonality in general. This was just posted on a separate video, which is more of an educational deeper dive, which looked at a range of macro micro cycles. So look out for that on our archive. Looking at seasonality, this is essentially a regular and predictable pattern that recurs every calendar year. It's a monthly pattern. Cross asset, although it's typically known and popular in the equity market space, every industry exhibits unique and seasonal trends based on a range of different factors, specifically sentiment, weather, and demand supply drivers. One of the most popular seasonal patterns in the equity market space is sell in May this month and potentially go away. There's a nuance on that second part of the mantra, but essentially that pattern itself is known for summer volatility, which is why it works more often than not. I do want to say, for disclaimer and educational reasons, this pattern is known to be less reliable, but in my experience, there's a reason for that. It's all about application, turning the theory to practice, and understanding the nuances to the pattern. So let's dive deeper into this for a better understanding. Now, if we just step back and look at the overall broad pattern, sell in May and go away basically means sell in May and don't return until November. Now, originally the saying was sell in May until St. Leger's Day. For those veteran, older seniors in the UK, where I'm recording from, will know that originally that was based on the former UK racehorse season in November. And so back then, the stockbrokers were alluding to that, and essentially sell in May, come back for November. That means ending that negative seasonality pattern in October. And of course, we know October to be the anniversary month for market falls and crashes. So that does make sense. And when you test it out, the average return, which is what we're looking at here, the sell in May SIM pattern, averages below average returns of single digits, 2-3%. 65% of the time it's up, but less than other trends, and the average correction can be 8 to 9%. Now, what's interesting is if you compare this to another pattern called the best 6 months, BSM, and that's from November to April. Now, if you want to look at the most reliable seasonality pattern, it's the flip side to the SIM pattern. That is November to April. And if you just buy and hold during that period, you will likely outperform buy and hold. So pin that insight and do the testing yourself. You'll notice that on average, it does prove out. Now, the actual stats show a few percentage point gains, and this is ultimately, varies according to different researchers, so you can get bigger numbers elsewhere. But do know it's been tested by financial institutions and academic research. Ultimately, broad brushstrokes, sell in May underperforms, and the best 6 months, which is the flip side, November to April, outperforms more often than not, and more so when compared to buy and hold. Partly because you're stepping out of the volatile season, you're managing your risk by doing so, and then you're making the best of the following 6 months. So there is some good intuition to this. Let's zoom in. And when we do so, we can see that it isn't just the big picture, broad brushstrokes in terms of sell in May, return in November, or buy in November and come back in April. There are stages to the seasonality pattern. It begins with the January barometer, which is a heuristic indicator for performance for the rest of the year. You can see there at the top, and I'll just quickly highlight it there. The January effect, strong start to the year, indicates a strong performance for the rest of the year. Incidentally, this is data on the US equity markets going back 100 years and just giving you that seasonal pattern that typically happens. Then we get the sell in May pattern that often begins in April after the strong earnings season, which then falls into the month of May. You can see the drop in performance there from high to lower, but here's the big point. The first drawdown is in June, not May. So if I was to reframe this pattern, I would say sell in June, not May, or perhaps prepare in April and May for a sell in June, which is then interrupted by the midsummer rally in July and August. You can just see here, July and August are your oversold reaction periods that often lead to the next second stage of the drawdown pattern, which is September. So the biggest fall is in September, and that leads to the September, October, autumn fall crash pattern that takes effect. And recall that October is the month for anniversary falls and crashes, 1987 being a case in point. Now, finally, the annual seasonality pattern typically enjoys a year-end rally driven by portfolio rebalancing and boosted New Year sentiment. So from a tactical, short-term opportunistic framework, you can see there are different ways to trade this. Now, for investors, you can still follow momentum and trend, but you can trim or manage risk at any one of these stages, particularly during the summer volatility and in particular September and October. For traders, you can look at the long or short side of this, as well as cross asset to see how this pattern plays out in different ways. Now, if we zoom in to a much more detailed level, we can see that the month of June can truly be volatile. And that is the month that follows this monthly vlog here in May. We can see stage one of the sim pattern biggest drawdown, which occurs in June. You can see the red bars on the low side. These are all months of June's going back several years on US equity market. And the three biggest June outliers, the last one being the most vivid in our memory, is the 2022 rate shock. And you can see that was the biggest on record compared with 2008 global financial crisis, just here in the middle. And then to the far left in history, 1962 presidential candidate Kennedy slide, which is known for some of those historians out there. Typically, this weak or big drawdown in June leads to an oversold reaction. Remember that micro behavioral part of the pattern just alluded to in the previous slide. And that's what gives you the liftoff for the mid-summer rally, typically in July and August. Shifting on from that, now we're looking at the average seasonality pattern for that period that then follows. We had the midsummer rally that giving you the elevation on the left side of the slide in July and August, and the peak out zone. This is work that I've done over the years, back testing 100 years worth of data when consulting with various institutional clients. And you can see here that the peak out zone is in late August into early September, and thereafter we get the fall crash cycle following, marked by the biggest drawdown in September, often triggering a false low in and around that time, usually late September, early October, but the true low actually typically being in October, and for that reason, October is remembered more than September because that's the low that people remember. But the volatility tends to blend between the 2 months, September, more from a statistical average perspective. But do recall the pattern that we're looking at here. Elevation, midsummer rally after a big drawdown in June, not May, but June. That then leads to, the elevation leads to a mean reversion risk in early September, and then October to follow. That's the main statistical average pattern of this seasonality rhythm. Now, let's car park that for the moment and switch to the US presidential election pattern, asking the question, how does this impact the sell in May pattern for this year of 2024? And most importantly, why is the US presidential election pattern potentially different this time? Now, the presidential election cycle theory, developed by stock traders almanac founder E.L. Hirsch, posits that equity market returns follow a predictable pattern each time a new US president is elected. Now, let me explain that in simple terms. This is the policy market transmission system. When a political leader in the strongest economy in the world, United States, wants to get re-elected, then they will use policy levers to impact markets, but also to alleviate sentiment with the voting populace in order to get re-elected. Now, typically that will lead to a positive performance in the market in that election year, but on average, it does underperform non-election years. It's just that there is a variation in the pattern in some election years over others. The big sweet spot is typically the midterm, where more policy levers can be used, less so in the election cycle. And there are various studies as to what to expect, and I'll go into that in a moment. So according to this theory, US stock market performance weakest is in the first year, then recovers, peaking in the third year before falling in the fourth. It's still a positive year, but it underperforms normal years. And this is the final year of the presidential elections term, after which the cycle begins again with the next presidential election. Now, the chart that you see there at the top is developed by Ned Davis Research, and they've done a lot of in-depth analysis in cycle framework, particularly the presidential election. And just below, you can see a chart by Morningstar showing the varying scenarios. So you can see their pre-election years that were positive, 22 versus 2, presidential election year, 20 versus 4, post-election year, 14 versus 10, so a little bit more evenly spread, a little bit of a coin cost, and midterm, similar statistic there, 14 versus 10. So what is more predictable is the presidential election year and the pre-election year. Otherwise, it can be an even split for the other patterns. Now, most importantly, to the summer months ahead, which is why I'm talking about this now, as we go into the sell in May pattern and approach the summer months thereafter, there is analysis suggesting that there is this sweet spot period during US election cycles in the summer months. Returns have tended to lag in the opening of the months of the election cycles, as primary elections are held in January through to April. You can just see the numbers on the chart down below, creating uncertainty about which candidates will make it in the general election, although this year is nuanced for reasons you can imagine, and I'll explain in a moment. Summer months typically outperform, all the results across each cycle vary, and I'll share that in more granular detail. The election year performance has improved in months following an election as certainty eases. So just focus on uncertainty versus certainty the switch between the two and how uncertainty leads to underperformance versus a relief rally thereafter post-elections in November. That's the general pattern that is tried and tested. So let's ask the most important question. Why could this time be different? And why should we avoid applying a one-size-fits-all approach? Two-part answer. Most importantly, the setup. Not since 1892, according to research from Goldman Sachs, has a defeated incumbent challenged the sitting president who defeated him 4 years earlier, with public views on both already clear. You can see this chart here on the top, where both Trump and Biden are neck to neck with a few percentage points apart, but early on in the election process, not later, which is typically the pattern. So the expectation and the certainty is higher in terms of candidates that are going head to head. Where this is more impactful is the second part in terms of the varying scenarios, and that's because of the potential significant impact from policy shifts. Case in point, looking at markets like the interest rates in terms of central bank action for a variety of reasons, including the fact that the central bank chair will be finishing soon, and so the president-elect has already voiced not wanting to bring them back again. So there are implications there for what could happen, but certainly rates in general in this rate-sensitive environment, and also the changing of role in central bank policy, US dollar, and volatility. Now, key point here is FSC members should watch for policy market implications. So look at how this might impact markets, but most importantly, look at these key issues in fiscal, tax, regulatory, trade policy, monetary policy, and geopolitics. And of course, that last part is the wild card that could flip the narrative at any point in time, as it already has, regardless of who wins out in the election. So all of these are a range of different factors that could tilt the market scenario either way, and why we should caution a one-size-fits-all approach, and certainly ask ourselves the question why this time could be different. And just to end, latest market insights, S&P 500 behavioral pattern still in play, although there has been a surprise to the upside, marked by a potential bull trap signal above this rising trend channel near 52.50 on the S&P 500. I'll just circle it there on the chart. The last time we rose above it was in March, made a peak, and there were some timing signals that I spoke about in the last vlog. Then we had the correction back under the ceiling of that trend channel, which led to a subpar 5% correction, less than expected on my side. But essentially, that risk remains if we were to break back under 52.50. Remember the amplified effect of a triple whammy of headwinds, momentum exhaustion, rotation fragility, and cycle asymmetric risk that remains. However, we still need price confirmation, so a sustained close beneath 52.50 would need to trigger a sharp reversal. And now what's interesting from a behavioral pattern perspective, this would renew the throwover signal, i.e. when the market pushes higher, breaks a resistance level, and then reverses, therefore leading to a bull trap squeeze, and also a renewed double top bearish pattern if this risk scenario were to unfold. And if so, the minimum price objective would be 10%, which is the base of the channel and nearby the long-term 200-day average. Of course, there could be overshoot risk in this potential scenario. Now, most importantly, let's look at the timing to end in terms of FSC cycle and model. The price and time divergence continues, although with a downside bias on the timing side. So we'll see which one wins out soon. But essentially, if you look at the combination of 173 and 53 on the cycle model, the implication is for a decline in May and June. If confirmed, this would lead to a typical seasonality oversold midsummer rally in August and September, thereafter leading to the autumn-fall crash pattern of September and October, as shared with you on the previous educational slides, ahead of the US elections in November. So closer to the time, we'll have to review the analysis in our FSC vlogs and see how things may have confirmed or changed. But for now, this is what the analysis is suggesting, and do look at the FSC cycle model for further timing direction. Now, keep in mind, this is not predicting price magnitude impact, but purely time. And so the implications are continuing for price and time divergence, but downside bias in the coming weeks ahead. So that's it for our FSC monthly vlog on will sell in May work in 2024 and the impact of the US election, why this time could be different, with latest market insights, just to ground it all in the here and now of how things are changing. Thank you very much. This is your host, Ron William, FSC Development Director. Feel free to stay in touch via email, details on the screen, along with QR code for social connection. Happy to be engaged either way. Thank you on behalf of the Foundation for the Study of Cycles. Look forward to tuning in on our next monthly FSC vlog.